This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore. Well, the intro says for Canadians, but we're actually getting a lot of non-Canadian downloads.
All over the world. We're even ranking in Spain, I saw, on Spotify.
Oh, they knew you were there, maybe.
Perhaps.
Anyway, so yes, we're in Canada. A lot of this is pretty Canadian-centric, but feel free to listen from anywhere in the world.
Great guests like in the States, and we will get more Canadian guests, but boy, we've had a run of phenomenal interviews.
Yeah.
And Barry's up next week, which will be good.
Yeah. You know, I think that if anyone's listening to this and has not listened to the David Blitzer episode, I think that the title, it was like the history of the S&P 500. The title looked super boring. That interview was fantastic. If you haven't listened to it.
Yeah, and we're also getting great feedback on last week's, which was Jonathan Clements.
Yeah.
That was a great interview also. And even he commented on Twitter saying he didn't realize how much better interviews are when they're in person as opposed to over the phone.
I didn't see that tweet. That's good.
So it was nice of him. Anyway, so we have an offer to throw out just to do a little beta test. We got some Rational Reminder swag. So if you go and put a review, which we really appreciate, there's been some very kind reviews, which we, again, appreciate a lot. If you happen to do one, drop us a note that you've done and tell us which one it is, and we'll get you a choice of the limited edition coffee mug or the swanky, super soft.
Oh, it's got to be the shirt, I think.
Cotton shirt. Well, people might like the mug.
Yeah, you're right.
But the shirts are pretty snappy. So
we debated making an offer like this because we don't want it to seem like we're buying reviews, but we started doing this podcast, and I don't know, you're doing a podcast, so why not get some mugs made, I guess?
Want to get swag.
And then it's like, maybe we'll get some shirts, I guess. Now we've got these mugs and shirts, but it's like, what are you doing? What are we going to do with them? I told Cameron we should just get 2 mugs, but he convinced me we should get more.
So we did get 2. I got him 2, and I got 98. So we have all these mugs and T-shirts here. So drop us a note if you put a review on that.
Yeah, write a review on iTunes or I guess whatever platform, and send us an email telling us which one it was, and I guess your address, and we'll send you some Rational Reminder swag. The mugs are cool too, but the shirts are pretty cool.
Anyway, so we're back after being on vacation for a few weeks. Some good topics, education discussion, S&P
education 500. Savings plan. Yep, it's good. Good episode. We'll keep the intro short.
There we go.
Welcome to episode 56 of the Rational Reminder Podcast. It's Cameron and I back together.
Feels like it's been a long time since we've been in front of the mic. We're feeling kind of rusty.
We had a few guests in a row, which we don't usually do, but we were both away, and we were feeling rushed to get an episode recorded, so we just decided to fit one of our pre-recorded guest episodes in.
So I haven't really seen you. Can you briefly say what your trip was?
I know, I haven't seen you either. Yeah, so I went to I drove from here in Ottawa to Nova Scotia, and then took the ferry over to Newfoundland.
How long was that ferry ride?
7 hours there, but it took you to Port aux Basques, which is on one end of the island. And then we had to drive all the way across to St. John's. We did that intentionally. We wanted to do the drive. And then on the way back, we took a different ferry from Argentia, which is 17 hours. So you sleep on the ferry.
Kids must have loved it. Great.
Kids loved it, yeah. People seem to think we're crazy for doing a road trip with 3 young kids, but it was totally fine. Kids were great.
It's awesome.
I spent four full days deep in the woods hiking and camping with a friend of mine right on the coast, on the East Coast Trail, which was that was quite an experience.
And you were literally off the grid for that time.
Oh yeah, no cell services. It was a little bit I don't know what I'd call it, intimidating, where there were points where we had no cell service, and you're an 8-hour hike in both directions away from any civilization.
So if something went wrong, you'd have trouble.
Yeah, exactly. But it was amazing. When we were in that spot, we ran into this pod of humpback whales. So we're probably 100 feet away from these obviously massive whales swimming around, breaching out of the water and stuff.
Wow.
It was cool.
Very cool.
Where were you?
Almost 2 weeks in Spain. Went to Barcelona for a few days. What an incredible city. Unreal. Super hot. Great weather. Great city. Lots of interesting attractions, and the architecture and the whole gaudy part of town. And then you've got the beach there on the Mediterranean. So we tour around during the day and hang out at the beach. Then we had a week on the island of Mallorca in Palma. Again, amazing town. We were in this little boutique hotel right in the old fishing part of town, and again, walked the beach, and beautiful old, my gosh, it's so old, the cities and little narrow lanes. We had a great time. What a fabulous food and interesting people. It was really nice. But now we're back at it. So I guess that was our current topic. Number 1 was our travels.
How much time did you spend thinking about bond funds versus GICs while you were away?
I did not spend a lot of time thinking about that, but I know you're wanting to talk about it.
Oh yeah, I thought about it a lot. No, I'm just kidding. I thought about it before we left. So we're calling it a current topic. We're fitting into that slot of our podcast, but it's kind of a portfolio topic, but it's also kind of a financial planning topic. But the reason we're calling it a current topic is that it's based on an article that Jonathan Chevreau just wrote for MoneySense, and I was quoted pretty extensively in the article. The title of the article and the question that it's answering is, are GICs right for retirees who want fixed income? What do you think?
Well, I'm always amazed at how many articles you read where advisors slam any sort of pooled alternative, like any sort of bond fund or bond ETF. And I'm always amazed at how many people just love GICs, even though it's just a repackaging of some fixed income investment.
I think a lot of that preference for GICs that you see from people is a lack of understanding of what's actually going on from an economic perspective. When you own a GIC, when you own a bond fund, people think it's scary. I mean, bond indexes, they're not super easy to understand. The management of a bond index fund is not super easy to understand. It's very much different from a stock index fund. And the biggest one is that bond funds change in price. And if you have a bond fund in your account, it can become the market value can get lower than the book value. And you think, oh no, like I'm losing money on my fixed income. This isn't safe at all.
Yeah. And if you don't understand what you're buying, like I can remember, and I may have told this story before, but gosh, probably 25 years ago, worked with someone who recommended people put short-term money into a long-term bond fund. And that's when rates spiked. I think it was early 90s, and rates spiked overnight. I forget all the details, but I remember that fund went down, I believe, probably 10 or 15% overnight. And that's when someone learned a lesson pretty quickly what duration is.
Right.
So agree, when you buy a GIC, you don't have to worry about duration. But when you're buying any sort of pooled product or even a bond, you have to worry about duration.
But this is the tricky thing, is that even when we have a GIC, if you have a 5-year GIC and a 5-year bond fund, say they have similar duration, just for argument's sake, the bond fund's still going to change in price if interest rates change. The GIC is not going to change in price, but the economic effect on you, if interest rates go up and you still have this GIC locked in at 2.5%, you're now taking that 2.5% while everybody else is earning 3.5%.
Right. But you can see people that buy GICs just don't want to worry about it. I'll worry about my price variability on the equity side of my portfolio, but I want to pin down my GICs and I know what I'm going to get at maturity.
But that's a problem. This is what I'm saying, is that in both cases, the economic effect on your portfolio is the same.
I agree, obviously. And it's much harder to rebalance portfolios with GICs because you don't have liquidity.
Yeah, lack of liquidity. And then one of the big ones, and we were kind of just talking about it with duration, is that with GICs, and maybe this is fine. Maybe it's fine to have a shorter term tilt in your fixed income portfolio. I mean, even if we look at like the fixed income that we use from Dimensional, it's got a shorter average duration than like VAB, than the Vanguard Aggregate Bond Index.
Right.
So maybe
that's around 8? And the Dimensional one's probably between 2 and 3.
A little higher, I think.
So you should probably define duration for people who may not know what duration is.
The amount that the price would change in the bond portfolio with a 1% change in interest rates. That's the modified duration.
The higher the duration, the more sensitive you are to rising interest rates.
Another way to think about it is how long it would take for you to recoup your loss, all else equal, with a 1% change in interest rates. 1% increase in interest rates. But anyway, a simpler way to think about it is that longer durations are generally riskier because you're going to have bigger price changes with interest rates. But as we know, risk and expected returns are often related, specifically when we're talking about risks that are priced, which term, risk, duration is one of those. It's a priced risk. So you expect a positive return for taking on term risk. Or maturity risk, whatever you want to call it.
And you got to wonder how much money flowed out of bond ETFs and bond funds last year into GICs. I'd love to know what that aggregate number is. And then you go and look at what the returns have been so far this year on these bond funds. Many have done between 5 and 8% year to date.
Right. Yeah, they've been fantastic.
Even plain index one has done that well.
Yeah. Oh, yeah. Well, VAB has done extremely well.
That's the total bond index.
Canadian bond, and VBG, which is VBG, which is Vanguard Global
ex-US.
Global Aggregate ex-US. It's also done really well. But you look back last year, the 1 and even 3 year returns for those bond funds were pretty bad. But all of a sudden you go back and revisit those 12-month and 3-year returns after this 6-month period, and they look pretty great.
Yeah.
So if you're comparing GICs to bond funds last year, say in December of last year, of course it looks like GICs were the better option, and they were over that time period. But returns, as we know, come quick.
Yeah.
They come in, well, in this case, in 6 months or whatever.
Well, I just looked at the DFA Global Fixed Income Fund over the past 5 years. The return has been just over 3%, 3.07. And they went back and found a 5-year GIC posted 5 years ago, and it's 2.55. I mean, I know that's just one little micro example, but in the fund, you had liquidity the whole time, able to rebalance.
And it's globally diversified. So you're getting exposure to fixed income across the world. You're not focused on Canadian fixed income, which there's probably some value to. I did a blog post earlier. I've got the numbers here so VAB, at the end of 2018, the 1-year return was 1.16%. And 3-year return was 1.56%. That's for Vanguard Aggregate Bond at the end of last year.
Which is why people will say, I could have bought a GIC and done better.
Right. And then you look now, or as of June 2019, VAB is up year to date, 7.24% at the end of June. And the 3-year trailing return is 2.34%. Now, that's before tax. I didn't look at the after-tax returns for VAB ending June, but I did this blog post earlier this year looking at a 5-year GIC ladder that I created using historical GIC rates. So it's like a perpetually rolling 5-year GIC ladder. And I compared that to ZAG, the BMO Canadian Aggregate Bond Fund. And both before and after tax, over that time period, and obviously this is going to change depending on the time period, but over that time period, the bond fund beat the GIC ladder, before and after tax. Because one of the things with bond funds is people get worried with the premium bond issue, which can be an issue, is an issue. But even with that.
To me, I get so much peace of mind having it in pooled funds because it's taken care of, whereas people view the GICs as being taken care of. No, just give me the bond allocation. You can rebalance as you see fit based on your overall asset allocation. So I get more stress if I was to own GICs, but I guess a lot of people like the peace of mind of GICs.
It's a psychological, well, I guess that is what peace of mind is, but it's a psychological benefit. From an economic perspective, with a rise in interest rates, you're no better off with GICs than you are with bond fund.
So why do so many advisors disagree with you?
I don't know. They don't understand the economic impact of interest rate change on GICs, maybe. I don't know what to tell you. But with a bond fund, like you're going to yes, it's going to drop in price if interest rates go up, but then you're still receiving coupon payments from your bonds. You're still receiving maturities. Well, you're probably not receiving maturities. When a bond fund gets too short a maturity, it's sold inside the bond index and then anyway. You're getting cash flows coming in. And as soon as your interest rates rise, you can now take all of your cash flows from the bonds that you already hold in the bond ETF and reinvest them at the now higher interest rates.
Exactly.
You can't do that with the GIC.
Correct.
Until it matures.
Correct.
Unless you have some sort of monthly interest GIC, maybe. I don't know. Do those exist? Monthly? I know you can get annual GICs.
Yeah, but then you got to manage it.
Right. Then you've got reinvestment risk. That's absolutely true. I guess you have that with the bond fund too, though. Anyway, there was a paper that Vanguard did last year just showing that having some amount of, and there's a diminishing return to doing this. Like if, I can't remember what the optimal, I don't know if there was an optimal allocation, but having some amount of global fixed income hedged to Canadian dollars really improved the risk-adjusted returns of fixed income.
But that makes sense. You're getting exposure to different yield curves.
Of course. Different economies. Like, of course it makes sense. Different interest rate environments, all that stuff. And obviously, if you're doing GICs or all Canadian bonds even, you're missing out on that. Yep. I think that's about it for that.
Yeah, I think that's good. So next topic, the portfolio topic, is a subject that you're doing a video on.
Yeah, so the video is done, but it is an interesting one where people often ask this question of, and I know Dan did an article for MoneySense about this a year or 2 years ago, but it comes up often enough.
Dan Bortolotti.
Yeah, Dan Bortolotti, Canadian couch potato. It comes up often enough that I thought it was worth addressing, but it's the question is the S&P 500 globally diversified? And the argument goes that it gets, that the companies within the index get about half of their revenues from foreign sources.
Right.
And therefore, you've got foreign...
Coke is a global company.
Right. Stuff like that. Apple's a global company, all that kind of stuff. And the other piece of that whole argument is that the S&P 500 has done really well. It's beaten everything.
Yeah, we've talked about that a number of times.
It's beaten active funds. It's beaten the U.S. market as a whole. It's beaten global stocks, like whatever you want. Maybe it hasn't beaten Bitcoin, I guess. Does Bitcoin beat the... Yeah, Bitcoin's beaten the S&P 500. There we go.
Oh, it did?
So the S&P 500 is not that great then if Bitcoin can beat it. I'm just joking, obviously. the other argument is that correlations between global stocks are increasing. So why should you even globally diversify if you're not getting a low correlation when you add global stocks to your...
And that's especially true when things go negative, correct?
Correlations increase.
Like look back in the crisis, everyone panics together.
Exactly.
Not necessarily the same amount, but the direction is the same in panic times.
Correct. All the correlations increase in panic times, and markets drop together in panic times. So I think do you think people are getting lulled in a sense of comfort with just owning more and more U.S. stocks? Because so many people are questioning on Twitter, a number of people who we follow who are in kind of our factor framework saying like is factor investing dead? Should you just go long U.S. growth stocks and that's it? Oof. Well, we've talked about this before. Is it different this time? All that stuff. I think that with the S&P 500, so that's not necessarily U.S. growth stocks, but there are some in there. Well, a lot probably. But if we just look at the S&P 500, I love that, and we've talked about this before, so if anyone is tired of hearing this story, then I'm sorry. But that post from Jared Kaiser from Buckingham, where he used bootstrap simulation. So he took...
That's the supernova.
Yeah, or the S&P 500 goes supernova is the title of the blog post I'm talking about. But he took all of the monthly returns for the S&P 500 from 1926 through, I think, October 2018. So all of this massive bucket of monthly returns of actual historical data for the index. And then he draws a monthly return out, plops it into a return series, and does that 116 times. So that gives him a 116-month return series, which you can compare to the actual returns of the S&P 500 over whatever.
And how many of those did he create?
100,000 of them. So 100,000 simulated historical periods that we could compare to the S&P 500 over... Do you have the time period there?
Yes, so March of 2009 to October 2018.
Yeah, there we go.
So that roughly that decade.
Right. So he took this 100,000 range of possible outcomes with the bootstrap, and he found that 0.57%, only 0.57% of these simulated outcomes beat, in terms of risk-adjusted returns, the actual performance
that just happened.
That has happened, yeah. So, I mean, when we're talking about, is this going to continue? I mean... So
it's an extreme event.
It's I think, I don't remember his exact words, but he said something along the lines of the actual result was almost statistically impossible. And that his kind of sentiment around writing the article was like, this has happened, but it's such an outlier. It's probably not reasonable to bet on this happening for the next 10 years.
And if you look at the period before then, from 1970 up until that period, right? So that's that's a fair chunk of time there, 39 years. The S&P TSX returned 9.4% compounded. The S&P 500 did 9.6 compounded. And the MSCI EAFE did 9.3 compounded.
Pretty close.
So they're all very similar returns.
Most interesting thing about this, and it feeds into our conversation about diversification, or should you just own the S&P 500, even though the S&P 500 beat those other indexes over this time period, ending 2009 or June 2009, if you combined all three of them into a portfolio and rebalanced it monthly, your annualized return increases to 9.84%.
So higher than any one of those three.
Correct. And you get a lower standard deviation, which is that is what you would expect from diversification.
Because you're rebalancing, selling high, taking advantage of volatility in prices.
Yeah. So that's diversification at work. Free lunch. Higher expected returns with lower risk, which is a pretty big argument against just investing in the S&P 500. But I think one of the things you mentioned earlier too is the correlation and how it's not that great of a measure. Correlations increase when the market drops. But I found a paper from AQR that was really interesting. It was a 2011 paper. And they said that, like you said, when there's a panic, when what they said it more scientifically, they said when risk appetites change, which is a panic, prices from all different markets can drop at the same time. But over the longer term, and their argument in the paper is that investors shouldn't care about short-term correlations. Right. Over the longer term, market returns are driven primarily by economic factors specific to whatever country we're talking about. So their argument is that even though correlations may be increasing, even though correlations may increase in down markets, that's not a reason not to diversify. Which, I mean, it makes logical sense.
And then the data in there about the U.S. stock market currently making up 55% of the global market capitalization right now. But that has not always been the case.
Yeah.
So incredible data in there. So was it from that paper that they talk about in 1989, Japan made up 45% of the global stock market?
This is from a CFA Institute, published a book on market history a while back.
While at that time in 1989, the US was 29%, but from January 89 through June 2019, so up to now, Japanese stocks have returned 0.61% per year on average.
Pretty crazy. That's before inflation too.
So you just don't know what can happen to an entire
and now
country or
Japan's
region.
8% of the global market. That's pretty
Down from
crazy.
45. It's completely crazy.
And now US is 55. And it's like you can look at that and say, well, it's going to keep going, but maybe it will. I mean, US is pretty great, but Japan was pretty great too. And it is still pretty great. Just their stock returns haven't showed it.
Right.
We've talked with the Hendrik Bessembinder paper that came out last year, or 2017 maybe. And it's that quote that's being used quite a bit now, at least in our world, showing that 4% of US stocks drove all of the returns of the US market from 1926 through 2016 or something.
Yep.
He just came out with a new paper. Did you see it?
No, I didn't.
Yeah. I was pretty excited to see it. So he looked at global stocks this time. The data set's not as long, but from 1990 through 2018, this is mind-blowing. Like 4% is crazy. 4% of stocks driving all the return. In this case, for global stocks, 1990 to 2018, 1.3%, 811 of the 62,000 global common stocks in the study explained all of the net wealth creation in excess of what could have been earned by T-bills.
Mind-blowing. This is why you always make the point about reliability and get safety in numbers. Some people might look at that and say, well, our job is to find those 1.3%.
Right.
And that's why I always laugh at these high conviction portfolios that we often see and hear from potential clients.
If you can pick those 811 stocks, you absolutely killed it.
But people view that as their mandate as opposed to in the framework of a financial plan, let's reliably get you to a successful investment experience.
Right.
It's a whole different mind frame.
Right.
And that's the approach we take. It's better not to blow it than try to be a star by picking it.
They also found that 61% of firms created negative wealth, destroyed wealth. So just 49% created,
39% created any sort of positive wealth.
And then 1.3 drove.
A handful drove all of it.
Right. Yeah, I mean, it really is amazing.
Diversify and rebalance. It's our main message. Okay, so you have 3 kids. I have 2 kids. Our kids are at the different ends of the spectrum.
Right.
So my kids are drawing down on their RESPs. So I got real life experience on that end, and you are saving for your kids' educations.
You've got experience on that end too, to be fair. You've already saved.
I've already saved, but I'm saying we've got current experience on both ends, saving for years and then drawing down on the other side.
And we've actually had, like we get pretty into the weeds with some pretty technical stuff, but we've actually had a lot of questions from listeners to the podcast about RESPs. Like, can you cover spending strategies and education savings plans, saving strategies? Surprising. Okay,
so the basics. Registered education savings plan. So you do contributions with after-tax dollars. Lifetime limit per child is $50,000. The federal government matches 20% of contributions up to $500 per year. So if you put in $2,500, they'll match it with $500, and that money goes directly into the RESP for the child's benefit. If you have some catch-up room to do, you can do double-up payments. You can put in up to $5,000 if you have the room and get up to $1,000 per year of grant. And if you want to know what room is available for your child, there's a super easy 1-800 number to get that information from the government.
Super easy. And they're great.
Very helpful. They're very good. It's a very good hotline.
But you have to call. Like, for example, we can't call on your behalf.
Correct. So we'll often call with clients in the room and make sure you have their SIN numbers with you. So the lifetime maximum grant that you can get is $7,200. So if you contribute $2,500 per year, by the time they reach 14 and a half, they pretty much have aged out of the grant.
Of the grant, right.
So you have to make sure you don't blow over. So we'll watch for that for clients to see if they're no longer getting a grant. Then you can decide whether or not you want to continue to contribute up to the $50,000.
And if you start late to catch up on all the grants, you have to plan to have stopped making contributions, grant matching contributions, by the end of the year that the child turns 17. But if they're 16 or 17, you can only make contributions when they're 16 or 17 if there's at least $2,000 in the account prior to that, or if $100 has been contributed in any previous 4 years before they're 16 and 17. So it's not like the deadline is 16 or 17. It's like you have to have done some stuff by the time they're 16 or 17 in order to get those last couple of years of grant matching contributions.
So I've met a lot of people who haven't saved into RESPs, and the kids are like 12, 13, 14, and they say, oh, I don't have any extra cash. I just want to do my RRSP. And I'm like, well, will you be using your line of credit or some other form of debt to pay for it later on? Oh yeah, that's what I'll be doing. Well, then why not do it now to get the grant? Because the expected return should be as much as your debt is costing, but you're getting the 20% kicked in. So some people have done that, but it's just to be aware you have to get it going soon enough so you can't just back end stuff it.
Right. I think one of the biggest hesitations, like I've talked to people who are pretty late in the saving game and have never used the RESP. And it's because there's some perception that the money's stuck, or if the kid doesn't go to school, you're kind of toast. But it's not. It's actually pretty flexible in terms of what educational programs qualify, but also in terms of what can happen to the funds if the child never goes to school. Right. Like it's not a death sentence for the cash.
And actually, in all the RESPs we've done over the years, I've never seen that happen.
I've seen a couple where it's a different situation, where an RESP may have been started and then the child when they were like a baby, and then it turned out the child had a disability, and the RESP in the end can be rolled into an RDSP. That's a pretty specific situation though. And
we have one that moved to the US, so a US school that they're considering may not qualify.
Interesting.
But it's super easy to take funds out. Once a child's enrolled in school, they just send in the certificate, and you can take out up to $5,000 of the
grant and growth.
The grant and growth within the first 90 days. And after that, you can take out as you see fit.
As much as you want, as long as you're still enrolled, or even 6 months after their enrollment period ends. Like it's
right.
pretty,
but there's no flexible. Linking to expenses. A lot of people think you have to submit expenses and prove what it costs.
You know where I think that comes from? I think, and this is me, I read this online. How about that? I haven't verified it. But with the group RESP plans, which are pretty predatory, like the CST or whatever they're called, like the scholarship plan, with those ones, I think you do have to verify expenses. I think that's where this comes from.
Could be, but in our world, we don't.
Absolutely.
A typical self-directed RESP, you don't.
Yeah. Just another reason to avoid those scholarship plans.
In terms of asset allocation, so what I did when my kids were young, I did all equity for the first 6-8 years, and then switched it over to 60-40. And then I recently switched it to 40 equity, 60 fixed income. And there's 2 years left to use it up.
One of the really interesting things that I find about asset allocation for RESPs is that when you're thinking about asset allocation for the RESP, people will often think about the time horizon as being from today until the child enrolls in school. So say from today until age 18. But the reality is it's from today. Well, a couple of ways to think about it. If you actually need to use the money in the RESP to cover education costs, the time horizon is from now until they enroll, but maybe until they're done school. Like you could take the money out at the end of the enrollment period. But the other interesting thing about it is that you don't have to take the money out and spend the cash on school.
No.
You could take the money out and, use some other cash to cover school costs, like your income or whatever. And the money that comes out of the RESP could be invested somewhere else. So it's not like if you're 100% equity when your child goes to school, the only thing that means is that you can take the money out of the RESP in a tax efficient manner, because we haven't mentioned yet the grant and growth are taxable to the child as long as they're enrolled in school. That's right. But you could do that. You could take it out while they're enrolled and then reinvest the money. It's not like you're forced to
TFSA or something.
Right. You're not forced to take the money out and take the loss on an investment that you had in there. It's kind of like how people think that with the RIF, when you start taking minimum RIF payments, like if you have investments in there, you're going to take a loss if it's down. It's like, no, you can just take the money in the RIF. You're going to pay tax on the amount that's down, which is actually a good thing, right? Because you're paying tax on a lower amount. Yep. But you can take the after-tax funds and go and reinvest them in your TFSA or taxable account or whatever. You're not forced to spend the cash, I guess.
But many people will be using it to fund their education.
Sure. So in which case your time horizon is more constrained.
People really don't like seeing the RESP be too volatile in those last few years before they go to school.
Yeah. Oh, yeah.
It's mental accounting for sure, but still.
I agree. It is mental accounting, but you're right. And in a lot of cases, what we've done, like you mentioned going to 40-60, but for a lot of clients, we've built a 4-year GIC ladder inside the RESP to match up with their expected education expenses. We kind of mentioned it, but maybe worth talking about more explicitly. If the child never goes to school, what happens? I said the money's not going to disappear. But in a self-directed account with those scholarship plans, I think the money does disappear. I think.
Yeah, I don't profess to be an expert on that, but in our world, it doesn't disappear. You always get your money back.
Yeah, so
government always gets their money back.
Right. But I think one of the big things that's pretty interesting is that an RESP can remain open for 36 years. Mm-hmm. So the child's 18, doesn't go to school. Well, maybe they'll go to school 10 years from now. So you can leave the money in the account for a while.
And so many places qualify.
Yep. Yeah, I had notes on that.
CEGEPs, trade schools, colleges, universities, and other institutions certified by the Minister of Employment and Social Development.
Yeah, I looked at that list of other institutions, which is on the Government of Canada website. It's pretty broad.
But it's really is a no-brainer. You get your money back, government gets their money back, and any growth comes back to you, taxable plus a surtax, because part of that growth was
taxable to the child.
Correct.
Oh, sorry, are you talking about if you're...
if you wind it up, no, it comes back taxable to you.
If you're winding it up,
and you pay tax because part of the growth came from the grant growth. So
tax plus 20% penalty on the growth.
Yeah, which is fair.
You can also roll up to $50,000 of the gains into your RSP if you have room. So they've made it pretty flexible. Yeah. With a family plan, so if you have, instead of having like an individual RESP, if you have both of your kids or multiple kids like I do in your in a family plan, then all of the growth can be pooled together. So I've got 3 kids. If one of them goes to university and 2 of them don't, all of the investment growth from the contributions and from the grants earned by the 2 kids that don't go to school, all of the investment income can be used by the 3rd child that does go to school.
You just can't share the grant.
You can use, each child can only take out up to the maximum $7,200.
Right. But if you maximize for the 3 kids,
right,
the 3rd child can't use the other 2 siblings' grants.
Exactly. I think one of the things that's neat to talk about, it's a trick that a lot of people don't realize, is the RESP super funding, which we often do this for clients that if you have the cash available. But what super funding means is so Cameron, you mentioned the $50,000 lifetime contribution limit. And we also mentioned the $7,200 in maximum grants that the government will give you. To get those grants by age 14 and a half, like you said, if you do the $2,500 a year, you will have put $36,000 into the account. There's $14,000 of contribution room. So $50,000 minus $36,000. There's $14,000 of contribution room that will never attract a grant, no matter what. So you can take that $14,000 and you can just dump that into the account today. Yep. And it can start growing tax, whatever you call it.
You just have to make sure you don't blow over your limit because then penalties will come up.
Right.
So you have to be careful, but if someone's detailed enough, it's no problem.
And the other interesting thing that we looked at a while ago was, what if you just took the whole $50,000? Forget about the grants.
And just do it when the child's born.
Just do it when the child's born. We modeled that a while back. I can't remember the expected return that we used, and I didn't redo the model for our conversation today. But the findings that we had then were that the expected outcome was almost identical with dumping the whole thing in versus super funding and then maximizing every year. But our conclusion to continue super funding as opposed to dumping it all in was driven by the fact that the $50,000 lump sum fully relies on market returns, whereas the super funding and then annual grant matching contributions, you're relying on market returns, but you're also getting the guaranteed grant boost.
Plus, people like getting the grant. There's a huge behavioral bias there too. But if the government grant's going to make it a more reliable outcome, why not do it that way?
Exactly. So I think that's anything else that you had for the RESP?
No, I think that's good. For the RESP, the bad advice of the week, we don't really have a topic for it, but you have a video coming up again that is going to bring out all your friends, all your dividend friends.
So someone sent me a video on Reddit, whoever that was. Thank you. Obviously, Reddit's anonymous except me because I use my real name on there. But someone sent me this video of a dividend investor from the US who made a video about dividend investing, and they used me, like my video about dividend investing, as their sort of intro, and then their video as a rebuttal against what I had said. Hearing people talk about factors, this guy kind of said, yeah, it's kind of interesting that there could be other factors other than dividends that are explaining these returns, but I can't remember what he said actually, but he had some sort of non-evidence-based rebuttal. But it's like it's really hard. It's really hard to look at something like factors, which are the workhorse model that allows us to understand how financial markets work. It's kind of crazy to me to look at that and say, yeah, some people might look at the market this way, but it's like, no, this is how
professional academics look at the data.
And it's how the market works. Like these models are the models that we're using because they work. It blows my mind.
And if you want to compete with it, go publish a peer-reviewed paper.
Right.
And go toe-to-toe with Fama and French and
show me the model.
People. But seriously, you can't just turf academic research like it's some bunch of quacks in a in a think tank somewhere.
Yeah.
Jump in, compete then.
Without data, you're just another person with an opinion. The other thing that this person said, I was going to say too, with Fama said to Thaler, or Fama told us when he was speaking to a group that I was with, that he says to Thaler that until Thaler has Thaler's behavioral economics, right? Yep. Richard Thaler, both Nobel Prize winners, right? Fama tells Thaler that until Thaler has a model, EMH is the only,
it's pretty funny.
There's no behavioral explanation for anything until you have a model. I have a model, therefore efficient markets is the explanation, or the 5-factor model is the explanation. So I got one more thing on this dividend thing. So the guy said in the video that companies that pay dividends, it puts sort of pressure on management to be really responsible and make good management decisions so that they can keep paying their dividend. It also forces them to focus the business on cash flow, which is going to lead to good stock returns.
It's a great story.
Man, stock returns, what explains future stock returns? The price. That's it. The price. If the price is low relative to whatever, relative to book, relative to profitability, if the price is low, then your expected future returns are higher. But that has to be in the price. So the idea that good management practices are going to increase stock returns, all that means, what you're saying by saying that, my dividend investing friend, what you're saying by saying that is that the market has mispriced these stocks. So we're saying that dividend-paying companies have better management practices, but the market doesn't realize that. That's what we're saying by saying that that dividend stocks with good management policy are going to have better future returns. We're saying the market is mispricing them, which is sure. That's a tough argument to make, though, I think.
I'm nodding. For those who can't see, which is everyone, I'm nodding in agreement.
Oh, I've got one more on that. So the other thing that, and this has been twice now, there have been two sort of, and the people that created these sort of answers to my dividend investing video, they've both got a ton of views, a ton of comments. So people are watching them, which is interesting. I think it's good that it's creating the dialogue. And same as that Globe and Mail article. Remember that? That got a ton of engagement too.
It's actually fun to read all the feedback and some of the people's comments and how they take pot shots at you. It's actually quite entertaining reading.
So two of these guys, man, both of them have pretty big followings of their own, but they both said something that I found just fascinating. They both said something along the lines of, I don't know why this Ben Felix guy is taking shots at dividend investing. You go talk about index investing, but we're going to go talk about dividend growth investing. But they're both totally fine approaches to investing. They're both just as good as each other. No one's better than the other, and people should do whatever they're comfortable with. But it's no, there's a statistically reliable way to do things. If your goal is a statistically reliable retirement outcome, there is a right way, or at least a most reliable way to do this. It's not no, do whatever you like, do whatever you feel comfortable with. No, that's not how I view it. Sure, if other people want to do what they're comfortable with, but they should be doing that with the understanding that what they're doing is not reliable. It's kind of like the rent versus buy decision. Sure, you can buy or you can rent, but you should be making that decision on the basis of the financial outcome being the same in either case, depending on the numbers.
Well, everybody, Ben is back. Ben's fired up.
I'm sweating, but it's because this room we're in is so hot.
All right. Thanks for listening.